I teach all my students this. It's like you have to get third party verification on all of your input. You
Mm-hmm.
can't just blindly say, all right, I'm going to increase rents $150 per unit and we're going to do some rehab and we're already what 300 per unit below market. So if we increase it to that and then we start increasing it 150 a year, it's like, yeah, that looks good on paper, but it's not feasible. You want to have third party verification on every single number you put in.
Mm-hmm.
And that's one of the big red flags is you're trusting but you're not verifying. And
Mm.
so it's like if you have a property manager who's going to be running the property, you want them to give you a budget and you want them to tell you what they think they can increase those rents to be.
Are you frustrated watching your hard-earned money ride the knee-jerking Wall Street roller coaster? Are you looking to diversify into alternate investments and set them on autopilot to achieve financial freedom? It's time to learn the ways of the wealthy. It's time to think outside the stocks with your host, Madhavi Jain, an immigrant from India and ex-IT professional who will bring you industry experts to illustrate a passive and holistic financial approach to build not just passive income, but also your generational wealth. Madhavi is on a mission to change the financial trajectory of one family at a time and 1,000 more to go. Are you going to be part of this vision? And now, without further ado, here is the host of Think Outside the Stocks, Madhavi Jain.
Hey, welcome back to Think Outside the Stocks. I'm your host, Madhavi Jain, and we have a very interesting guest with us today, Jason William. And Jason, you are here with my most favorite topic, and that is underwriting. So we will talk about a lot about numbers in today's episode. So, roll your shoulders, get your pens and pencils out. You're going to take notes today. I'm very excited about this episode. Before we go ahead, I do want to mention that this is information and education purpose only. Whatever we are providing as an education on this podcast, please be sure to do your own due diligence on it. Consult your tax professionals, your lawyers, so that you can implement this strategy in your financial structure. Jason, welcome to Think Outside the Stocks.
Thank you, Poppy.
Absolutely. So, Jason, before we go ahead, I always like to talk about three fun facts about our guests, and you actually have many interesting facts. The first interesting fact is, hey, we have a doctor in the house. We have our PhD. I mean, Jason has done PhD from Texas Tech University in chemical engineering. That's very interesting, Jason. And with 20 plus years in real estate and his the PhD, now he's kind of creating this massive education about underwriting, and he applies all these techniques to his underwriting. And he has that's his second fun fact, that he actually has like a mastery course in underwriting. So that's really close to his heart. And the third fun fact, Jason, I would love to share is that you are a proud father of three girls and a boy who actually has special needs. And we will talk about it in today's episode, and how, sometimes when life gives you challenges and we kind of taper it and create some completely different journey out of it. And, would love to talk about that and what has it done to you and how it has motivated to kind of change a little bit of path of yours. So with that, Jason of Iron Card Underwriting Mastery Program and many other Lauren Capital, as well as one of the conferences that I've spoken at, Academy Presents. You have a lot of hats that you wear, and we would love to explore all into it. We are so humbled by you being here. Thank you so much for being on the show, and welcome back again.
Thank you for having me.
Thank you, Jason. So with that, let's jump into a little bit about your journey into real estate and from chemical engineering to real estate. Do you want to allude to a little bit of that path and just a background about how did you get here?
Yeah. So my wife, Angel, and I both sort of grew up with real estate. Our families did it. So it was always something we just assumed we would do. And since she came from that background, I came from that background, it was like never a discussion of, oh, all right, well, let's try to get into real estate and make money. It's like we're going to do that. And my dad always mentions to get into real estate, find a business that makes your money, and then you can do whatever you want as a
Mm-hmm.
career, for fun or whatever. Now, granted, it does take a while to get up to that point.
Yeah.
So I picked a career, one because it's challenging, two because at the time I thought I'd make a whole lot of money doing it, and so that was chemical engineering. And it's like, yeah, I'm going to be a chemical engineer, make a lot of money, and then I'll get into real estate after that. Well, then 2001, September 9/11 happened. I
Mm-hmm.
graduated in May of '02, so I couldn't find a job because nobody was hiring. So then I
Oh.
went to grad school thinking, all right, I'll go to grad school. I'll even more money as an engineer,
Mm-hmm.
earned my PhD, got out, and then realized, yeah, I'm not making as much money as I was hoping to be making. So definitely we got into real estate when we started it when I was in my graduate career. So we bought our first house, we lived in it, and then we started renting it out when I got my first job. And then we cash out refi, we started rolling it over into some other single family homes, cash out refi those. But it was a long process. It took maybe like 5 years to get any equity out so we could buy a new one. Then I learned about multifamily syndication and haven't even looked back since. And
Mm-hmm.
when I realized I could buy properties with other people's money, then it's like the doors were open, my eyes were open. It's like now I can do what I want, and so I have been. In 2022, I was laid off from my position. My company moved to Houston. I was
Mm-hmm.
hired on as a consultant for the company, but what it let me do is concentrate more on the real estate aspect. And I haven't had to find a new job in over 2 years because I've been doing my real estate thing. So that's more or less my journey in a quick nutshell. So
Nice, nice. Thank you for sharing that. I know, market cycles we have seen at different times, and I have seen 2008, especially with the real estate impact, job impact. It just kind of makes these twists and turns, but we end up taking a path that otherwise we wouldn't have taken. So I think, you and me, we are grateful for what has happened. Otherwise, we wouldn't have been here doing what we do. And not just that we have found the path, but we are passionate about educating others. And that's what I like about you.
yeah.
When you have created this, entire system for yourself, and now you're looking at it and trying to educate and trying to have the right fit forward for your investors. I really love that. So let's talk about how did you get to the ironclad underwriting?
So when I got into the multifamily aspect, I was learning underwriting. I didn't know anything about it.
Of course.
I have a mentor who started leading me in the right direction. My wife Angel goes to a lot of meetups, and so she was getting a lot of resources for me. I was helping people with their underwriting, but really I was learning more about it as I was helping them. I was always kind of like one or two steps ahead of them, so I was able to help them, but I didn't know everything yet. I still don't know everything, but I am still working on it. And so I was getting all these different models, from different programs. I was creating my own model because I didn't find anything that I really liked. And so I
Mm-hmm.
started creating my own. And then I mean, that's what we use today. We use it to buy all our properties. We put all our information through my models and to determine. I know some coaches, they'll share you a model with you that they don't even use. They just have one that they send you, but they don't use it themselves. We actually use our model ourselves.
Mm-hmm.
But it was in BEC of 2023. People like came up to me in droves, like, "Hey, can you teach me how to underwrite?" Or, "Hey, can you sell me your model because the one I'm using just not working?" And
Right.
then from that conference is what really spawned my ironclad underwriting mastery programs. Like I never thought I would teach underwriting. I never thought I would be able to sell a model. I was like, it's just what I created on my own, and people found value in it, and so that's what kicked that off. Mm.
Love that, Jason, and congratulations on taking that path because it's not only helping you, but it's helping many, many others because getting the underwriting right, the finances right,
Yep.
is the first step forward when it comes to multifamily. And there, so many coaching programs, and like you rightfully said, so that there is a model in that coaching program, but the question is that when they are underwriting their hundreds of properties, are they using that model? And that's pointed out so correctly that if they're not using it, why they're proposing it, right? So I love that
Yep.
differentiated that you have. So let's talk about, I mean, our audience today is passive investors. These are people who do not have so much time. I mean, underwriting, as you and me understand it, it could be really a giant task. I mean, underwriting a property could take hours, but understanding that the model itself could also take many, many hours, right, to get
Yep.
really expertise on that. And we have our listeners who are, tech savvy, medical professionals, or, other really active, W2 earners or business people as well. They do not have time for that. So let's talk about, first of all, um, what is underwriting and why should they actually uh, should consider spending a couple of hours because now they're putting their hard-earned money, hundreds of dollars, hundreds of thousands of dollars into syndications, multifamily, and or otherwise, right?
Hmm.
So let's talk about what is underwriting and what are the things that they should keep in mind. Why should they keep the underwriting in mind? Why is that the top one priority?
So underwriting is more or less just running the numbers on a property to see if it's going to make money or not, or how do you change up your business plan so that you can make money with a certain property. I've helped many operators, people who are buying the properties, but I've also helped many passive investors as well. Um, with passive investors, sometimes they may get underwriting from the group they're going to be investing with. Sometimes they won't. You almost always get a pitch deck. So
Mhm.
I show or I help people go through a pitch deck, what to look for. If you don't have the underwriting, you can start seeing if things are making sense.
Yeah.
I've gone through many pitch decks before and the numbers just aren't adding up from like your second slide where you're doing this versus the 40th slide that has all the financials and stuff. It's like, well, these two slides aren't jiving, so what's going on? And so I help people look for those little nuances that, yeah, the pitch deck looks perfect and it's amazing, but for some reason the numbers don't add up. And so as an investor, you want to make sure those numbers add up. And the details, the devil's always in the details. It's like how the group does one thing is how they're going to do everything. If they're overlooking the smallest details, which are easy to fix in a pitch deck, what details are they going to overlook whenever they are running and operating a property? Will they just say, "Oh, hand wave and hope somebody else takes care of it," or will they take care of it themselves? So these are a lot of things you can actually pull from a pitch deck without even
Hmm.
going into the numbers yet. So,
Love
and
that.
I've
Love
I've
that.
helped a lot of passive investors in that regard.
Yeah, love that, Jason. It's kind of completing that story. I quite often get a request from my friends, my family, and something probably like off CrowdStreet or other platforms that, hey, this is a deal in Austin, and I'm in Austin, right? So, hey, this
Mhm.
is really in Austin, and what do you think? It has great numbers,
Yep.
annualized returns 20% or 25%, and I always say that don't fall for the shiny numbers, and what you're talking about, knowing the real story behind the numbers, real story behind where the things are adding up from the second slide of the pitch deck to the 40th slide of the pitch deck, and that kind of tells that complete story. And that's behind the curtain a look a little bit. Passive investors, when they're putting 50,000 is typically the minimum, so that's a
Yep.
lot of hard-earned money that they're putting into. So take that couple of hours, do a little bit research, do a little bit of analysis. uh, what is the most important aspect that you do? I mean, we think outside the stocks. Our focus is capital preservation, right?
Yep.
We're trying to understand and analyze that risk. It's very difficult to kind of quantify the risk, right? But that's what you're trying to do. You're kind of doing the risk profiling to see how it impacts your investment strategy. So let's talk about the risk and how do you relate the underwriting with the risk and the capital preservation, kind of completing that circle.
So outside of underwriting, I think the biggest aspect is the team you're investing with. I've invested with a team. Underwriting looked good. All the numbers added up and made sense, and it was 100% doable. But whenever it came time to execute the operation, the team didn't raise all the money they were planning on raising. So they were doing all their they're doing all their capex from the cash flow of the property. So the investors didn't see anything,
Mm-hmm.
but the construction firm got every little bit, and it was vertically integrated. So they were doing their own construction. They're paying through it with the cash flow, and then they ended up selling it. And I think over 18, 20 months or so, I think I ended up getting like $1,200 or something like that,
Wow.
as the investment was supposed to be a 2x equity
Mm-hmm.
multiple in like 3 years. And I got at least I got my capital back, but I mean, I would have rather invested that in something else. And so even if the numbers do look good and can work, you still are betting on the jockey, not the horse. So
That's true. That's
so
true.
that is probably the biggest risk, I think, there. And if you have a good solid team or you trust the team, then that's when you start diving into the numbers. So yeah.
Yeah, very, very well said. Bet on the jockey. We talk about that in Think Outside the Stocks as well. Is the operator. An operator with their experience, if they have seen different market cycles, right? They know how to handle the challenges, because in every environment there's going to be different challenge. If they're
Mhm.
equipped to handle the challenge and kind of change their strategies, that's what is going to impact. A good operator can make a good deal and make it like really good, but a bad operator can take a good deal, but
And kill it.
you don't know, you can kill it, right? So let's talk about our favorite topic here, underwriting now. For passive investors, really, without getting it more complicated, keeping it at enough depth level, what can we tell them today, if we are to identify that, hey, let's look at this as red flags, and when you see these deals, and if you don't see in your pitch deck these questions answered, then go and probe those questions from the operator. So at least at least if you and me together can save them from stepping on one landmine together,
Mhm.
let's try to do that. So let's try to identify those red flags, and whether it's 5, 7, 10, whatever we can cover today, let's try to jump into that. So tell us about few red flags that passive investors should keep in mind, to stop stepping on those landmines.
So every I teach all my students this. It's like you have to get third party verification on all of your inputs. You
Mm-hmm.
can't just blindly say, all right, I'm going to increase rents $150 per unit, and we're going to do some rehab, and we're already what, 300 per unit below market. So if we increase it to that and then we start increasing it 150 a year, it's like, yeah, that looks good on paper, but it's not feasible. You want to have third party verification on every single number you put in.
Mm-hmm.
And that's one of the big red flags is you're trusting but you're not verifying. And
Mm.
so it's like, if you have a property manager who's going to be running the property, you want them to give you a budget and you want them to tell you what they think they can increase those rents to be. You can't just do some hand waving and assume it's like, well, this property down the street is doing this. And it's like, no, this is specific to this property. That property down the street might be a class A or a B plus, and you're sitting here at a C minus. You can't do the same thing.
True.
So that
True.
that is that is probably one of the biggest ones, is getting verification on all the numbers. And that is very easy to put in your pitch deck. Say, hey, this is what our third party verification people said. This is what we should be able to attain. It's reasonable. So if they don't put that in the pitch deck, then they either don't know or are hiding something, or they probably just don't know they should put it in because they don't know what they don't know. So
Got it. Got it. I love that. Trust but verify. And if they have done the third party verification, I think that's important to highlight in there. That's number one. Let's go to
yeah.
the next one.
So another one that I've seen, and not so much recently, but sort of during the time when interest rates were climbing,
Mm-hmm.
people were using temporary trends for the long game.
Mm-hmm.
So before interest rates were climbing, San Antonio was booming. They were getting 30% year over year increases in rents.
Outrageous. Yeah.
I helped people with their underwriting, and they put that into their model that they were planning on doing 25 to 30% increases year over year. It's like
Mm-hmm.
that might work for a year, 2 years, but that's not going to work for the
Sustainable.
long game.
Yeah.
And it's obvious is now they're having to decrease rents because people are moving out of San Antonio into other markets. So
Yeah.
Austin's the same way. Phoenix, they've been on the decline. They might be on the up now, but like whenever those interest rates were climbing, they were dropping, and that's why places were getting foreclosed on left and right is because of all that. They were hoping to get the rents, and then well, the interest rates were a whole other aspect, but that's one big thing that I've seen
Yeah.
that
Yeah.
that
Not
I
just
just
an. Yeah.
scares me.
Let's
It's like,
talk.
why would you do that? It's like,
Absolutely, absolutely. And let's talk about it a little bit and how important it is, because you strike a really important point here, right? The temporary trends, right? I mean, sometimes what think outside the stocks. I mean, I'm looking at, and I kind of bring these investments in my fund model to my investors, right? And when I'm looking at and vetting these operators who are already, by the way, are under contract, they have done their underwriting, and I'm vetting them to see whether I should be bringing it in front of my investors, right? So I'm looking at
mhm,
their underwriting. And when I say that, I just want to see the numbers and I want to see the conservative underwriting, right? And sometimes I go back and say that, hey, your rent growth projection, it's not conservative, right? I want to see something which is in alignment with inflation at least, right?
right,
So it's,
mhm,
0% first year is what my comfort is, and maybe 3%, maybe 4% year three, four, but 3% starting, second year. That's kind of the conservative numbers I'm looking at. And why really, right? Because they will come back and say that, oh, it is conservative because CoStar is, projecting whatever 12% in this area and we did 8%. So it's conservative than CoStar, but that's
yeah,
again exactly what you said. It's based on temporary trends. We had inflation, and I quite often see the rent growth and inflation kind of going hand in hand, right?
mhm,
Inflation a couple of years back, we saw that it was just outrageous. And that's why, we saw the rent growth was. And as you pointed out, markets like Phoenix, Austin, we are seeing a negative, uh, it's a rent decline and it's going into negative territories while it's going to go and adjust, right?
yeah,
And those kind of numbers, when you go from 4% to 8%, and that's just like a 4% jump, but the IRR can significantly jump, right? That can
yeah,
take you from like 12% to even like 20%. And then that's exactly what we are talking about. The 20% is a shiny numbers going behind the curtain and kind of unveiling a little bit and seeing that is it even doable for them, right? Are they
yeah.
you're going to achieve it? So that's a very, very important aspect. Thanks for pointing that out. Let's talk about the next one.
So this one may or may not apply to limited partners or passive investors. I know a lot of LPs or passive investors are in like mentorship programs and they get in it so that they can get the deals. They're not looking to be operators.
Mm-hmm.
But one thing is that they're arbitrarily following that guru. They don't
Mm-hmm.
know. It's like this is what he says, so this is what you should be doing. It's like, well, this sort of goes back to the trusting and verifying, but in regards to who you are listening to and who you're putting stock into. I've known people who, and again, a few years ago, you can pretty much invest in anything and make money, and now you can't. I mean, people are losing deals, so it's like you have to
Yeah.
be. It's like it's really testing the strength of the operator now just because of the times. And so if you're just listening to a guru, you listened to him a few years ago when everybody's making money. It's like, yeah, this guy's doing great. But now your guru is doing capital calls. He's getting foreclosed on. He's now becoming ostracized and not becoming a guru anymore. And it's like, so you followed him because he was doing great things back then, but now it's not. So arbitrarily following a guru is one red flag that I've seen. And again, it just goes back to trusting and verifying. And so,
Yeah. Very important aspect, Jason. And let's talk a little bit about it, right? What you mentioned, that's really true. There is a lot of coaching program that got kind of induced into the market last 7, 8, 9 years or so.
mhm,
And a lot of them actually just rode this, the cap rate wave that we call it, and they
yeah,
didn't have to do anything. They didn't have to do anything because the direction cap rate was going. Even if you just sit on the property, even if you don't do any value adds, and you could sell it after 2 3 years, you would still get significant. You could 2x your investor capital
yeah,
easily, right? And if that became their track record and they did like thousands of units and they're like, okay, now I can do thousands of units. So let me create a coaching program based on what I know and let me teach other people. And now there are, hundreds of people plunged into these coaching programs and following the same things. And one of the riskiest thing, right? I've seen that, if the guru did not know how to manage the interest rate climbing up, and the rate caps, especially, and the students didn't know how to manage that either. And then suddenly there are a bunch of people who have got into this, thousands of units of properties without a rate cap or without sufficient rate cap, even if they had the rate cap. And
mhm,
suddenly these are the properties who are at risk. People they have turned their keys to their lenders. They have lost investor capitals. They have done significant amount of capital calls, dilution for passive investors. And this is, go to my heart because this is their hard earned money losing. And that's what I keep talking about.
yeah,
If they can stop stepping on one single landmine, if because of this podcast, right? That's totally worth it.
yeah,
So that's really important. I think you highlight that very well. And this is why I like to look at, going back to our discussion about betting on the jockey. What have they seen? What have different cycles that they have gone through? Like, look at you. You have seen 20 years of real estate, and with your families also probably even a little bit more, that growing
mhm,
up seeing the real estate. But when you see the cycle is going to throw you different set of challenges. Not a single challenge is going to come back and say that, okay, this is the same challenges. That, I mean, there are some challenges which are same, but there is going to be new challenge, and that's why it's really important for the team to be able to equipped with handling those challenges.
yeah.
So thank you for sharing that. Tell us about the next red flag that they should watch out about.
One thing that I'm a big proponent of is looking at like monthly cash flow or monthly numbers.
Mm-hmm.
Generally with a pitch deck, you might just get the annual numbers, and that's fine. But you want to make sure that their operating team is looking at the monthly numbers.
Right.
And the
Right.
reason why this is important, especially with like a big value add play, is when you're going in and you're buying a property that's 70% occupied and you're going to do some renovations and flip it around and bring it up to bring it up from like a B minus to a B plus or A, you're going to be putting in a lot of rehab and you're going to be
Mm-hmm.
facing a lot of vacancies or something, lot of outlay of cash.
Mm-hmm.
And so what I show my students, and I have models that show this, is like for year one, it says, yeah, you're going to be net positive. You're going to bring in $18,000 in cash flow year one. But
Mm-hmm.
what it doesn't show you is for the first 6 months, you're going to be going down 24,000 coming out of pocket because one, you have to make your insurance and your taxes, and you have to make your debt service. So all of that stuff is still accumulating. You're going to be negative until you can start getting those units occupied at the higher rates that you think you're going to be getting. And so, like, for the first 6 months, you're going to be negative 24. And then for the second 6 months, it's going to start doing a hockey stick. So at the end of the year, you're going to be up 18,000 or
Mm-hmm.
whatever.
Mm-hmm. But
But
you
you
have to
don't
go through
know
that.
that. Yeah, you
Mm-hmm.
don't know that if you're only looking at the annual numbers, like, oh, 18,000, that's about 1,500 a month. I can do that. And then it's going to grow from there. It's like, so no, you need to know if you're going to be doing capital calls on day one, or if you raise enough reserves to cover that downpour or whatever, or the low spot. So you need to put that into your business plan. And that is one thing I harp on, is like, what is it going to look like from the month? Or even if at a refi or something, you do a refi, you give all your money back to your investors, but now all of a sudden your debt service doubled because you got it at a higher principal. So now
Right.
you can't cover it. So then that helps you know how much capital you need to keep before you give it all back to your investors. And so that's just another
Mm,
aspect that I've seen.
I love this point, Jason. You kind of hit the hell in one nail in one of the biggest challenges that I used to have, because I used to see look at this underwriting, and by the way, I love this. I love this conversation. It's just like feels like we're bouncing off each other's challenges and kind of pointing our investors to a right direction. So
Yeah.
one of the challenges that I was talking about when you started talking about the cash flow and how you're renovating, right, is that I would look at underwriting and they would say that, okay, these are the number of units that's going to be renovated, right? And there is no schedule for the renovation, right? And that's the biggest challenge, because either they cannot assume that at the end of 1 year, all the units are renovated and everything is, hunky dory and everything is kind of up and running. And, with that, whatever occupancy that they projected, that's going to get there at the end of the year.
Yeah.
But the challenge that I was having is just kind of putting it that, okay, in a month, you can only bring so many units up, right? You
Mm-hmm.
cannot empty out the entire apartment complex, renovate everything, and then start putting people in there, right? So looks like from what you're talking is your underwriting model kind of takes a look at that systematically, that okay, this is kind of the schedule is, and these are your number of units that could be up in for 6 months, and then
Yep.
that's gonna impact this much of vacancy, and then gradually getting to that 18 to 24 month cycle where all the units are up, but on a gradual level. We're not expecting, because underwriting could be challenging if you don't understand, and as an operator you're using that model with somebody else, some guru created, and you plugged in those numbers and it's just assuming that everything is going to be up at the end of 1 year or 18 months or whatever.
Well,
That could
to even
pose.
prove that point, I've seen and I've helped numerous people.
Mm.
They are assuming it from day one, everything's going to be renovated and they can get
I
it.
wanted to be nice and not say no day one, Jason,
I
but thank you for saying
I
that.
have seen that so many times, and it's like, do you know what you're doing? And that actually goes into another of my red flags that may not pertain to limited partners, but I mean, it would at least let them look at it. It's like
Yeah, yeah.
people just blindly put numbers into a model and not really know what they do. And so,
And these are operators. These are, what
yeah,
you're really betting your
yeah,
money on this jockey and their operations. And they don't know they're having this challenge, and there's going to be cash flow problem in the first year, because obviously it's not going to be up at that rate after the renovation.
yeah,
And this is, I mean, we kind of started modifying our templates to kind of put that schedule in, so we knew what's that impact going to be. But if you're listening, I mean, this is really important, and this is why you need somebody who understands it. And Jason, quite honestly, I like my position because I feel like I'm a bridge between the operators, and the operators sometimes they're great operators, they know what they're doing, and that's why a person like me can read through this poorly underwritten or well underwritten
yep,
investments, and day and night difference, right? And that can bring to the investors, because the investors don't have time or expertise to look at it, to do that due diligence, right?
yep,
And by the way, we also use like a third party underwriting company even if I understand very well, we use third-party underwriting to kind of re-verify, provide all the T12 and, provide all the rent rolls and stuff and kind of re-verify, because underwriting is the prime most important aspect of any deal, of course, after the operators. So thank you for sharing that.
But underwriting is like so many people that I deal with, they just gloss over it, or they do some hand waving, and they don't treat it like it should be treated, and that baffles me too. It's like, well, I'll worry about this later, or I have the underwriter on my team, he knows what he's doing. You assume he knows what he's doing. You don't know really.
Yeah,
I mean, but I mean that I have, and I do help with underwriting. I have underwriting consultant and consultation, and people come to me already under contract, and they're like, does this deal make money? Because I don't know. I'm already under contract and we're supposed to close in 2 weeks. I'm like, you should have brought this before you even submitted an LOI, but let's see what we can do to at least turn your business plan around so you can figure out how to make money on this thing.
Absolutely.
So
love that. Let's talk about one or two point more, and then we'd love to talk about the Ironclad Mastery program and what it entails. So let's talk about a couple of red flags for our investors.
okay. Another one is not stress testing. It's like, or not stress testing enough.
Mm-hmm.
So, and what you can do is you go in and say, well, what happens if occupancy drops to 70%? Are you going to be in dire straits, or can you make it? I know break even says it's going to be 84, but how long can it drop down to 70 before you do a capital call, stuff like that? So that would be one aspect. Or what if it's like, well, what if the cap rates are growing at exorbitant rates, and you're going to be getting out, you're hoping to get out at 5.25, and it's looking like it's going to be 7.5. What does that do? And so that would be another thing, at least so you can have numbers say, all right, this is where we're hoping to be and shooting for, but we might end up in here. So there's just some other things you can stress test for. How long you hold it. It's like, well, what if we hold it for 36 months or 72 months or 84? Or what if we sell it at month 65? What is it going to look like? Because most people, they sort of round it to the nearest year. It's like, well, let's do it at 48 or 60 or whatever. But no, you can hold it for longer or shorter than a year and get rid of it. So those are some other aspects to do.
Stress test is so important. Thanks for pointing that out. I mean, there are so many aspects, right? The market rent, like you said, the cap rate, the occupancies, if you're refinancing the interest rates, there's so many stress tests that you can
when
do.
you refinance in month 24 or 27 or 36.
Yeah, exactly.
All those can affect your numbers as well. And
by
that
the way,
can also affect your cash flow for a few months as well. So,
and that 2x, or whenever they're seeing that 18%, 17% annualized returns and 2x in 5 years, every single aspect, by the way, listeners, we are talking about every single aspect, even individually, even if the 4 or 5 we talked about, 4 didn't materialize and 1 materializes of any of them, it's going to impact those numbers directly. So it's the validity. Why are we doing this underwriting re-verification on a property which is already under contract? Is because we want to make sure that the numbers that they are saying, they're planning on, the projections that they're saying, how viable is it for them to reach that numbers? And Jason, to give a glimpse around our processes, what we do is we take an underwriting and we really stab at it, right? And all these different aspects of it, what's the rent growth, what's the other conservative underwriting assumptions that they have, the insurances, the property taxes, the stress tests, and we kind of take certain parameters, 5, 7, 10, whatever the parameters, and push, make it super conservative, and then we take our underwriting model, not their model, a completely different underwriting model, plug those numbers in, and see now what's the IRR is going to be, right? So if they're projecting 17% and we push and becomes like 12%, 13%, which is still looking good, because not everything is going to occur, but some things are going to occur. And then, it will land somewhere in between. So I like that. If it goes to like 3%, 4%, percent, and sometimes it does, sometimes it goes even negative. That's definitely a deal that we don't want to go into,
Yeah.
because they have considered, I mean, I've seen deals, Jason, um, that they're just looking at property taxes, that they're going to reduce the property taxes, they're going to challenge it. And that's how there's just, the whole strategy, the like, or at least 70-80% of the strategy is coming up from just that operational efficiency
Yeah.
of property taxes. And it
Wow.
baffles me, right? So that's
Well, I mean, if you're in a state like Texas, which is a non-disclosure state, where you don't have to tell them how much you bought a property for.
no.
Let's say you bought a property for $10 million, and it was being taxed at 3 million. It's like, you're not going to go and say, "Hey, I bought this at 10 million. Can you tax me at 10 million?" It's like, no.
Yeah.
But what happens is the county see, oh, this changed hands, so it must have probably sold at this amount, and they can get access to a loan document or something. And they'll say, oh, we assume you bought it at 7 million, so we're going to increase your taxes to 6.
Yeah. Yeah.
Okay. And so now it's like, well, you can't do that because I bought it at 10. It's like, okay, we'll change it to 10. It's like, no. So you have to find someone to protest that. But
Right.
if they lose, I mean, your taxes doubled. It went from
Yeah.
3 to 6
Exactly.
million, and there's really
Exactly.
nothing you can do about it. And that happens all the time. So you have to be able to say, all right, well, what happens whenever the tax value goes up to 6 million? Where this is what it's going to be, and can we cover it? So, I mean, there's a lot in
Yeah.
Texas and other non-disclosure states that you have to take into account. And most of the time you don't know what you don't know. So it's like, well, we'll hire somebody to take care of it and bring it back down to 3. It's like, maybe they'll bring it down to 5.5. Who knows?
Yeah. Yeah. No, that's an excellent point. I mean, again, one assumption can change the entire outlook of it, right? So
Yep.
so let's talk about your program here a little bit. Is it something that even passive investors can reach out for and can get a help from you? How does it work?
So I have an online course. I can do either face to face like this through a Zoom call every week
Mm-hmm.
for about an hour, hour and a half. We have, it's about a 12 to 16 week curriculum, depending on the speed at which you pick stuff up and how quickly you, or not quickly, you understand stuff. I've had one student take 20 plus weeks. I've had another student take like exactly 12. So, I mean, it just depends on how you keep up with it. I mean, it's a course, so I mean, you're going to expect it to do some on your end. I also do it online where you can do it at your self pace, where you can watch like different modules and stuff and work through exercises. So I do it that as well. And then I have office hours for all my students once a week, 10
Mm-hmm.
10 o'clock on Thursday. And at least at the time of this being recorded, it might change later, I don't know.
Sure.
But at least an hour a week of office hours where you can come ask questions. We work through live deals. We go through pitch decks. I have some videos on YouTube of us going through pitch decks, so this would be good for your passive investors to see what do you look for in a pitch deck to make sure it's at least worthy of going on and finding out more information, or just washing your hands clean of it. So, and I also have a community in LinkedIn, or a LinkedIn group, where anyone can join, ask questions about underwriting. And that's another thing, is a lot of people, they don't know what they don't know, and they don't know where to go to find information. Yeah, there might be some YouTube videos, there might be some books, but I mean, those just basically cover the rudimentary stuff, all the textbook stuff, not actually what's happening. And so if you have a place where you can go and ask questions, and that's what I provide as well. So
Thank you so much, Jason. And I'll take the information and I'm gonna put it in the show notes. But where can they go on the website to look for the program?
so I can be found on LinkedIn. And also have ironcladunderwriting.com, where I have some sample videos you can watch. You can and I'm working on making some quick resources for you to download and stuff. I'm still working on that. I haven't gotten those out yet, but hopefully I will by the time this is aired. And so you can, yeah, you can go there, you can download stuff, you can schedule a time to meet with me on via Zoom, or you can go to our community where my wife has all her stuff, where we have all of her summits and stuff. It's all in the same community, just because it's
Love
easier
that.
that way for us. So
Yeah, I love what you and Angel have been doing, providing this content and value to audience for years now with your summits as well. So thank you for sharing that. So with that, we're going to move to our next segment. And this is the segment, we Think Outside the Stocks, our podcast. It's not just about multifamily. It's just not about syndication, but I focus on, growing, preserving, protecting, and passing your generational wealth because, we got to start doing that somewhere at some point, right? And I would love to go back to your unique kind of situation, a unique story, right? You being a parent of three girls and a boy, and you alluded to it that you puts you in a very, peculiar position. So we would love to know for you, what strategy do you apply to diversify? I mean, you're not heavily probably into stock market anyway, but you're probably heavy in real estate. So how do you diversify in different buckets, and how do you make sure kind of creating that vault and kind of planning um, after you, that how your next generation is gonna get hold of all these things and still keep it intact and not just kind of they're protected enough. So
yeah,
can you share that with us,
yeah.
please?
So my grandparents created a partnership with generation skipping trusts. So it
Mm-hmm.
like skipped over my dad, and I'm the
Oh,
beneficiary of it. My dad was a trustee. And so we have this template, and it's been going on for like 30, 40 years of what it's been doing. So it obviously works. And so we are using that to try and help build our legacy, help create wealth for my daughters. My son, he's special needs. He can't hold anything under his name, or else he
mm-hmm.
loses all his services. So we have to plan around that. So we have a special needs trust for him.
Mm-hmm.
And ultimately, what we want to do is we want to remove the financial burden of my son for my daughters when Angel and I are gone. We don't
Hmm.
want them to have to figure out how do we pay for his services if, well, I mean, how do we pay for his services? Like, I mean, I can get a job and hopefully have enough to cover it, or Angel and I are putting this in place so that they don't have to.
Right, right.
Now, granted, we are using a special need trust, so he doesn't lose services from the state, but he's still expensive above and beyond what the state will pay for. And
Hmm.
so that's where this comes into play. And then whenever he passes on, and assuming my daughters are still alive, then they would sort of absorb all of that special needs trust into them so that they can provide for their family, their kids. They can put their kids through college or whatever. So that is our goal right
Oh,
now.
wow. Wow. Very complex and very
Yeah. Well,
thought
and the
out.
thing is we don't do it all on our own. I can't imagine trying to figure it all out. So we do have advisors that we work with.
Right.
They have legal on their team. They have accountants on their team. So they have everybody all on the same page, because it's always hard trying to find a lawyer and accountant who will work
Absolutely.
together. So
Hmm.
they have all of this in place. We've also worked with a coach on how to navigate the whole state system, how to get on all the lists, and how much to charge them for rent and food and clothing and all of this, that, and
Wow.
the other.
Wow.
Because I mean, there are so many nuances you don't even know about, and if you don't know, then you'll never know even to think about it.
Yeah.
So
You
I mean,
don't know what, like you said, well, you don't know what you don't know.
so
Uh,
that's why we hire all these advisors and coaches to help us navigate all this. Because
Love
I
that.
mean,
Love that.
I'm in my wheelhouse. I'm out doing creating systems for numbers, and Angel's in her wheelhouse with creating relationships. And so we outsource other people, and that's one of the big things. Also, is we preach the who not how process. It's like, who do
That's
you
so
know that can
important.
help you versus
So
how
important.
do I get this done amongst juggling everything else? So
Yeah. And it's not about, that value and worth proportion, because sometimes people go into like analysis paralysis, and it's like, hey, if I want to create an estate plan, where is the cheapest source that I can find? Or, what's
yeah,
the easiest way I'm going to get done? No, you got to go to the experts, you got to go to the things that they have done hundreds and thousands of times and seen all kind of situations, and yours
yeah,
is not in unique situations. They must have seen that with somebody somewhere, right?
yeah, yeah,
And that's when you be an expert in what you do and let them be expert in what they do. That's a very good point that you bring in.
yeah,
Thank you for sharing that. So with that, we have kind of come to our final round, Jason. This was a really great conversation. And again, thanks for adding those tidbits. It's really important when it comes to underwriting, and everything that you shared today. So valuable. I hope our listeners took the notes down and, have at least some points to ask and check back if they
yeah.
can. But with that, the last round is actually my most favorite round. It's called rapid fire round, and it's nothing to do with real estate, but more of the personal stories. But sometimes, there's like a crossover questions too. So,
Yeah.
are you ready for the rapid fire round?
Sure, I am.
I see you down there, Jason. No, it's just going to be some fun little questions and, 30 seconds, 1 minute answers, short answers, or whatever you want it to be,
Okay.
right? So yeah, my first question actually going to be about real estate. That what is the most outrageous, when somebody gave you the underwriting, what's the most outrageous assumptions that you have seen that just hugely impacted and kind of made the day and night difference, that they actually didn't go for that deal or didn't go for that investment, completely.
So it was actually one, they were already under contract and they just wanted me to double check the numbers. And what I found is, one, they were increasing rents as if they were renovated on day one, like I mentioned earlier.
Mm-hmm.
But the way they put it into the model, they didn't know the model very well. And it ended up, they were triple dipping on that rent increase.
Oh my gosh.
Yeah, but they were already under contract. It's like, do you still have your outs to get out from it? Because I mean, these numbers don't
How
make
much money
sense.
do you have at risk?
I know it's scary, and what it comes from, these big mentorship groups that you find on Instagram or something, and they put over like fork over $20,000-$40,000, or even more sometimes, and they're just being led astray, and that's scary to me. And I've helped a lot of people in that regard. They
Wow.
spend a lot of money expecting a lot for their return for it, and they're not seeing it, and a lot of times they're getting misinformation on how to go about it, and that's
Yeah.
that's
Yeah. Wow.
yeah,
Love
that opens up a whole other can of worms. That
Can of worms. I know it's huge. Thanks for sharing that. My second question is going to be, and this is about you and me have a common thread. It's about mindset, right? And our common thread is Coach T. Coach T has been on my podcast too. Incredible to have him. So there's something with the coaching that inherently shifts, right? There is like a mindset shift that happens, and suddenly you are standing at that fork and you just pick another path, and there's a lot of growth just by shifting that mindset, that
yep.
2 shift, right? What is that mindset shift, if you remember and go back and kind of tell us about, has been for you? What is the biggest moment, biggest learning over the period of years that you have, that shifted your mindset so significantly that's your, it's a completely different daylight for you?
So this goes back to my wife also. When Anson was born, we kind of knew something was wrong. He got
Mhm.
diagnosed with Dup15q. It's a duplication of the 15th chromosome, similar to Down syndrome. Down syndrome is a duplication of the 21st chromosome. So he's autistic. He still wears diapers. He's 14 years old. So I mean, he can't help
Wow.
himself. But
Mhm.
back when he was still a baby, Angel was sort of freaking out, crying. It's like, what are we supposed to do? Why was he given to us? And And I flipped it around on her. It's like, well, what if it wasn't he who's given to us, but what if we were given to him?
Wow, goosebumps. I'm getting goosebumps.
So now we have to advocate for him because we're his gift. He's not necessarily punishing us. No, we're helping him. And so with that, it sort of creates a paradigm shift. And now anytime something bad happens, I kind of try to twist it around and say, well, and you've heard this, it's not life happening to me, it's happening for me.
For you,
And
yeah.
so what can we do to change how we look at things? Because he's our son no matter what. We're gonna love him. There's no return to sender. So now we have to make the best of the situation. And so that's how we do it.
I love that, and you guys have done incredible, and your mindset and your attitude towards everything has been tremendous. I give it to you for that. But amazing. Sometimes we are looking at a glass from the inside and we feel stuck, and there's a lot of going on because we're just stuck. But if you look at the same glass from the outside, it's suddenly the perspective completely changes. It's just so open, and it's just whole wide world out there. Focusing on what challenges you have instead of that what blessings you have, right? It's big words, but it really, when you're going through something like this, a mind shift changes. I hope
You have to consciously do it, because I mean, when you get into your habits or you fall back onto what you normally do, it's easy to get into that mindset where you're only looking at the glass from one direction. So you have to make a conscious effort to twist it. But the more you make that conscious effort to look at it a different perspective, the easier it gets. And then eventually you're going to be looking at the glass from all different angles before you even make an assessment of where you are, so that you know where to go from where you are. So
absolutely. Thank you so much for sharing that. And the last question, any last thoughts for our passive investors? I mean, it's quite scary out there. There's a lot of investments going wrong. There's a lot of capital costs going on. There's political pressure. There's so much, and people are like, am I supposed to hold on to my money? Am I supposed to invest into something? I was just, what's going on? The stock market is doing what it's supposed to do. The real estate is doing, again, going through the cycles. Any last thoughts that, you could share with our investors today?
What I would say is do your research and don't be afraid to invest. Yeah, it's like times are kind of rough right now, and we have the election coming up and we don't know what's going to happen. But if you're anything like me and you have money sitting in a bank account, you're eventually going to spend it away. It's like, oh, I can do this. I've got such and such money in my account. But if you take that out and you invest it into something, whether it's the stocks or it's a syndication or it's oil and gas or something, just do your research that what you're investing in, and then you understand what the risks are, and then it's not going to be so bad. Yeah, you might lose money initially, but if it's a long-term play, then you're going to make it back later on. So it goes back, do research on your operators, try to find out who also invests with whoever you're working with or planning on working with, and see what kind of returns they're getting, what kind of returns they're getting now that interest rates have gone through the roof compared to 4 years ago. I mean they're literally 2%, and now they're 6%. So I mean, that tripled your interest rate, that tripled your debt service potentially. So I mean, it could, you see what kind of trials and tribulations those operators have been through and how they came out at the end. And so you just need to do your research. And the people always say, well, what do you think is the riskiest investment? And to me, that is investing in something I know nothing about. So if you do your research on your operators, you do research on oil and gas, you do research on your stocks that you're wanting to invest in, you can mitigate a lot of those risks. If you just put $10,000 in the stock market and hope it's going to do something, yeah, that's the most risky investment I can think of. Or
absolutely golden nuggets, Jason. I mean, you can't sit on it. The inflation will kill it. If you put it in stock market, question yourself, how much do you understand of that stock market or the investment vehicle that you're going into, right? Golden nuggets. Thank you so much for sharing. It has been incredible conversation. So grateful to have you on our show. Thank you so much again. And
Thanks for
listeners,
having
thank
me.
you. Absolutely. And listeners, thank you to you too for listening another episode. And with every episode, we try to bring in more depth, more content, and today's with incredible guests. It has been one incredible conversation. Thank you for listening.
Thanks for tuning in to the Think Outside the Stocks podcast. If you enjoyed today's episode, please like and subscribe. Madhavi is on a mission to change the financial trajectory of one family at a time with 1,000 more to go. We hope you'll be a part of this vision. Please join our growing community, and to get your journey started, visit thinkoutsidethestocks.com to download your free guide on active income with passive real estate investments. If you learned something new, please share it with one person today. And if you have 60 seconds, please leave us an Apple review to help us reach more people like you. Tune in for the next episode.